So Ryan, Carl, good morning, and thank you for taking the time to join. I know you are both very busy these days. I'm actually pulled Carl out of something. I'm sure you will share with us some new and interesting insights on SPAC's momentum. So just before we start the panel, a couple of technicalities. As you can see, this is a Zoom webinar, and therefore you can only see us, not because we are more handsome. And please feel free to address any questions during the panel via the chat, and I encourage you to do so. So we are all invested in technology companies, and considering the exit path via SPAC deal or vehicle. I know some of you are already familiar with the SPAC, some may have already been part of the process. So we'll try to cover this from some basics to also current market conditions and trends, which is super important these days because the trends are changing, as you know. So Carl, I'll start with you. The floor is yours, and maybe just, even though many people on the audience are well familiar with SPACs, I suggest to start with a few words on the SPAC mechanism and process, and maybe a little bit on the statistics, SPAC sizes, what would be the target size, and its financial performance and pipe size, etc.
Absolutely. So what I'll do is I'll talk about the SPAC life cycle, go through the individual pieces of it really quickly at a high level. And then what I'll do is I'll weave in some of the recent market dynamics that we're seeing across each of those pieces and how it impacts, companies that are looking to go public via the SPAC. Really quickly, the first step is obviously the SPAC IPO. And I think there we've seen an evolution over the last few years where you've steadily gone from, call it 100 to 200 million, maybe 300 million in size. You've seen a step up where SPACs today can be anywhere from 500 to $1 billion plus. I do think that what SPAC investors have found is that there is sort of a sweet spot. I think you want to be in that, call it $300 to $500 million range. And what the reason behind that is, it just makes it a lot easier to find a target that is of the right size, right? And so you think about the sizing of the target versus the SPAC IPO, you want to find something that's anywhere from 3 to 5 times, potentially even greater in terms of enterprise value relative to the SPAC IPO size. And the reason is you want to basically minimize the impact of these sponsor promote shares, right? So that carry that the sponsor gets, right? You want to reduce that dilutive impact relative to the EV of the company. But you don't want to go too small, right? Because if you go too small, it becomes challenging to compete on larger assets, right? And so we recently went through a process where, we were looking at a $20 billion plus EV target. Our SPAC was 400 million. The competing SPAC was $1.5 billion. In a market like this where the pipe is potentially challenging to pull together, that became a real issue for us, right? And we ended up losing the transaction because the other person had more committed capital in the form of the larger SPAC IPO. As you go to the next step of the life cycle, it's obviously finding the merger target. And I think what you would find there is, we've seen that part of the market absolutely explode. Just a number of companies now looking to go public via the SPAC process, as they've seen others in their, in their sector or at a similar point in their life cycle go public. I think it's really beginning to, just increase the imagination of people in terms of their ability to go public. And we'll talk a little bit about why that's good and bad, right? I think, on the good side, it obviously opens up another avenue to go public, which is increased liquidity, increased sort of commercial, just sort of appeal. But at the same time, I think a lot of these companies don't realize that after you go public via the SPAC, 6 months out of the gate, you're a public company. And there's all the requirements that you would normally have, right? Both from just a traditional sort of, accounting, financial reporting, et cetera, but also just from a commercial standpoint, right? Where now you're under the public eye and it's, as a private company, you don't want to miss production targets. You don't want to miss product targets. You don't want to miss financial targets. It becomes even more painful as a public company, right? Because now you have an equity price that's marked to market on a minute by minute basis, when it's trading. The third piece of the transaction then is once you've identified the target, you have to raise incremental proceeds, right? So a lot of times, let's just say you have a $300 million SPAC, you go and acquire a company that's say 2 to 3 billion in enterprise value. the target may need another 200, $300 or more $1 million to go out and build their product, right? Or commercialize their product. And so what we end up doing is going out and raising additional proceeds via a PIPE. So private investment in a public entity. And so what that allows us to do is increase the quantum of cash that's received initially upfront, but it requires us to go out and find investors who are willing to put that cash up front, right? So that's a part of the market that's becoming incredibly active. And what I would say there is, you used to have just lower quality players in the pipes. They were looking to make short-term trades. They charge you an arm and leg to put in that capital. Today, it's become a lot more mainstream. We're seeing, BlackRock, Wellington, Fidelity, T. Rowe Capital, Neuberger, just best-in-class long-only type funds basically commit significant amounts of cash into the pipe market, right? So it has become a pretty viable piece of the pipe life cycle that everyone's using. The fourth piece is now you have the pipe in place, you found your target, so you announce the deal, right? So once you announce the deal, the SPAC equity price begins to trade as if it were the the public entity, right? And so now we go into the de-SPAC process. And what that is, when we raise the SPAC IPO, that is targeted at a very specific group of investors, right? So these are just hedge funds, arbitrage type investors who basically buy the SPAC units and then hold the warrants and potentially trade out the equity. There's different trading dynamics, but the idea is that they are not fundamental investors. They don't care who you buy. They don't care how long it takes you. They're just playing the arbitrage game, and they're treating it very much like a structured equity security. But once you announce the deal, what you need to do is actually go out now and convince traditional public equity buyers, right? So the long-only mutual funds, top tier tech hedge funds, et cetera. You need to convince them to come in and buy the stock so that the arbitrage players can leave. And so this is what we call the de-SPAC process. Usually takes anywhere from 2 to 3 months, from the time you announce the deal to when we actually close the deal. And what we're making sure of is a few things, right? One is the stock trades well, right? So that the deal is approved and that, we don't have to break the deal apart. Two is that when we come out of the gates and are the publicly traded company, that the stock trades well again, and that that you have real equity investors in your stock now. The last piece, which is probably the piece that the bankers talk about the least, is what happens after you close the deal, right? Now you're a public company. And I think that's something that people forget and don't really think about very much. I think I've heard, SPACs talked about as a backdoor into going public or a faster, easier way to go public. I would say that it's really not, right? In the sense that once you're public, no one cares how you went public. They don't care whether you did a direct listing, an IPO, whether you did a SPAC. You have to hit your financial targets, right? If you say you're going to deliver X number of vehicles, you've got to deliver those vehicles. If you say, hey, we're going to, if you're a space company, you say we're going to do our first launch, in first half of 2021, you've got to deliver on that, because if you don't, you get penalized in the public equity markets. And we've seen that now, where you have a number of these sort of futuristic SPACs, whether it's Virgin Galactic, whether it's Momentous Space, these are deals that, hit as high as 25, 30, even $60 a share. So, 5-6x out of the gates, that are now trading back down to, 10, $20 because they just haven't delivered on what they said they would, right? And investors are extracting a lot of value that they put in upfront. And so, at a high level, that's that is the life cycle that we go through as bankers and lawyers on the SPAC side. What I would just say really quickly on the market side, and I'll let Ryan take over, is, look, the market has obviously slowed. We're seeing it's driven by both the glut of supply on the IPO side, the merger side, but also just broader market volatility, right? I think we came through a 2020 that was incredible and unprecedented. And I think from that standpoint, there's been a sentiment amongst investors that there's just a need for a pullback, right? Whether it's SPACs, whether it's high-flying tech stocks, whether it's IPOs, whether it's convertible debt, like we've seen a slowdown across many markets. And I think, SPACs just being sort of a higher beta type instrument are going to be effective, most at the highest level. What we're also seeing is just competitively, there was a point in time where you had 10, 20 SPACs chasing after targets. I think the tables have balanced a little bit, right? Because now you have so many companies basically saying, hey, this is a great way to exit, so why don't I do this? And so now that I think the balance has shifted such that there's a little more equality, right? Where, SPACs also have a lot of leverage in terms of being able to say like, hey, I don't need to buy you guys. I've got 5, 10 other targets that I'm looking at. And so the negotiations just around structure and what you're willing to concede on the sponsor promo, the warrants, et cetera, I think we're seeing, less pressure on that than we had been a few months ago even. But, I think overall, what we're, I think the biggest thing to think about, and I'll stop here, is, look, I think the biggest implication of all this volatility is that valuations have never been driven by the SPAC, right? In reality, you have the SPAC come in and say, this is what we're willing to pay. But the reality is the market speaks on what the valuation is, right? Whether it's the pipe buyers who come in and say, we're willing to buy at this valuation, or equity investors saying that, hey, we're going to trade your SPAC, SPAC equity above $10 because we like this offering. That hasn't been an issue up until very recently, right? Like most deals have traded really well. Pipes, I think pipe buyers have been price takers for the most part. SPAC shares have traded well post-merger announcement. And so we haven't really had to think about validation of valuation, outside of what the SPAC sponsor says. But we're seeing that now, right? Just given the weakness in the market, we're seeing companies miss their financial production targets out of the gate. We're seeing just a lot of opportunities to invest. And so people aren't chasing deals up as much. And so as a result, we're seeing pipes that are getting repriced lower. And why that's important is you as a seller of a company may say, oh, this is great. This SPAC came in and offered us, 20, 30, 40% above what others are willing to pay. The problem is we've gone in those scenarios and then we go to market the pipe buyers say that valuation is off, like we're not there. And they've cut back pretty heavily on valuation to get to the point where they're comfortable, right? And so this is I think this is really the first time since sort of late last year where, pipe buyers are basically dictating what the valuation is in these deals. And so what this all means for you then is just, you have to be really thoughtful around your portfolio, right? As you think about the SPAC as a potential exit opportunity, it's, what are your other sources of fundings, right? How much do you need and when, right? Because one of the attractive points around the SPAC is it allows you to raise a lot of capital really quickly. But that becomes a little risky, right? When there's an increased risk of deal volatility of the deal falling apart potentially, right? I think, two is your company ready to go public, right? If you're earlier stage, how much conviction do you have in your product and your commercialization ramp, right? Where are you in that life cycle? Three is, have you done a lot of work over the last couple of years meeting with public equity buyers, right? Because if you have and they understand the company, that story becomes a lot easier to sell than something that's really new and no one's ever seen before, right? And we've seen that not just on the SPAC side, but on the IPO side where, on the IPOs, we've had IPOs where investors basically say, you know what, if I haven't met with the company 1 or 2 times prior to the roadshow, like I'm not doing the work because there's too many other things going on. I don't need to take on new names that I'm not familiar with, right? And then the last piece is just, what type of company are you? Are you, sort of a futuristic tech company in the EV space, battery space, or are you a best-in-class software company like an ironSource, right? Which is an entirely different profile. Like that is a company that was ready to go public via an IPO, 35, 40% year-over-year growth, 35, 40% EBITDA margins. That is a business that, that will do well in any environment, right? Now, that being said, that deal got announced and it's trading right at redemption value, right around $10.20. And so even there, you see the stress in the markets where that's a deal that I think, 2 months ago would have traded up 30, 40, 50%, from the time they announced the deal. And today it's trading flat to announcement. So that's what we're seeing on my side. So I'll pass it over to Ryan, for, I know I've gone on for a while. So
yeah, that's great. Sorry.
Oh, thank you, Ryan. So no, just to add, Ryan, on your end, anything you see about the SPAC structure that has been evolved, are people trying something new, playing with the warrants to promote? What are the latest trends that you're seeing, and whether it's negotiable? Let's put it like this.
Yeah, so just to add a little more context, to put some numbers behind much of what Carl said, there are, by our count right now, there are 435 SPACs that have gone public, but not yet announced a business combination. So there, for our VC friends on the phone, there are 435 potential SPAC counterparties that are actively looking for a business combination, and another 260 that have filed for SPAC IPO, but not yet gone public. So that's sort of the universe of SPACs that are out there, if you add those together, of course, you're at almost 700 SPACs between those that are public and those that are seeking to go public, looking for business combinations. And in the aggregate, they represent $200 billion of cash in trust, both between the ones that are public and the ones that have filed to go public. And if you look at the average SPAC transaction, the average value of the equity of the private company relative to the size of the cash in the trust account, it's about 5 to 1. So in other words, the average trust account is about $250 million, and the average equity value of a company going public through a SPAC is about 1.2 billion. What does that mean? That means there's potentially $1 trillion in SPAC M&A to be done in the next 24 months, because most SPACs have a 24-month life. So there is there is a lot. Maybe there won't be $1 trillion worth of SPAC deals that get done. So far this year, there have been $40 billion announced. So we have a long way to go. But to your point, Taylor, about deal terms, it's really interesting because SPAC IPOs have tailed off considerably. So we were averaging over 20 IPOs a week through January, February, and most of March. The last week of March, which was both Easter week and Passover, there were only 2 SPAC IPOs. Last week, we were back up to 8, but that's compared to an average of about 25 a week. So the IPO market has definitely slowed down. But what's interesting is that the terms, this is to your point, the terms have not really changed much. So we're not seeing the pullback on the IPO side, or frankly, I'm not seeing the pullback in the pipe market in the last few weeks as really significantly moving terms around. We are seeing sponsors saying, maybe we won't announce a deal this week, maybe we'll hold off on going to the pipe market for another week or two, but they are not jumping in to try to solve this downturn by giving up more of their economics. They're not saying, I will get a deal done in any circumstances because now is the time I need to get a deal done, and therefore I'm willing to sacrifice more of my warrants or more of my Class B promote shares. I have not seen that yet. We've certainly seen deals that have decided to take a pause in the pipe market and extend exclusivity between the company and the SPAC to try to get more time to see a little bit of a market recovery on the pipe side. But we have not seen SPAC sponsors trying to solve for the reduced interest by offering up more forfeitures, more of their economics to be sacrificed in the name of getting a deal done. I would say we are seeing generally some convergence. So if you think about the levers that a company has that it can use with a SPAC sponsor in negotiations, there's only a few terms there. There's the sponsor's Class B promote, that is the shares that the sponsor gets in the public company as compensation for its effort in doing the SPAC IPO, as well as finding the private company to take public through the SPAC. There's the warrants, which the sponsor actually purchases in order to fund the SPAC's IPO and ongoing expenses. There's the lockup, which is how long will the sponsor of the SPAC agree not to sell its shares after the business combination is complete. There are only a few levers that the private companies can pull, really. And we are seeing some convergence in terms there. There's, if not quite a standard structure for how the SPAC sponsor promote gets renegotiated, there are a few that we're seeing over and over again. And that's typically that the SPAC sponsor will fully vest in a portion of its promote shares, just as it expected to at the time it structured the promote. So maybe that's half. Half of the promote automatically vests at the closing of the business combination. And the rest of the promote that the sponsor would be entitled to, the sponsor is willing to subject it to an earnout based on the share price performance of the company post-de-SPAC. And so in a relatively common structure, you would see the SPAC sponsor say, okay, I did a $300 million SPAC IPO. I'm entitled to $75 million worth of shares in the combined company. That's my Class B promote. I'll take 37.5 million shares at closing, as I otherwise would have been entitled to. The other 37.5 million shares, I'll take half of those if the share price hits $12.50, so up 25%. And I'll take the other half if the share price hits 15, so up 50%. So we're generally seeing sponsors willing to subject some of their promote to the performance of the shares. And if the shares don't perform, the sponsor sacrifices that portion of its promote. The sponsor warrants are a little bit harder for the company to get its hands on. The sponsor generally takes the view that, unlike the promote, where all of those shares were purchased for only $25,000 originally, the warrants that the sponsor owns, those were actually purchased for $1 or $1.50 each. That represents at-risk capital. That's real cash that the sponsor had to put into the SPAC. And for that reason, the sponsor is usually less excited about sacrificing some of those warrants. Now, those warrants represent dilution. So from the company's perspective, you may well take the position that we want the sponsor to forfeit some of those warrants, give some of those warrants to company shareholders, maybe give some of those warrants to the PIPE investors to help bring the PIPE investors into the transaction. But for the most part, at least I'm seeing that the sponsor is saying, look, we'll renegotiate the structure of the Class B shares. We are not willing to renegotiate the warrants because we paid for those and we expect them to be fulfilled in accordance with their original terms. I don't know, Carl, if you're seeing something different than that.
Sorry, I was on mute. No, that's consistent with what we're seeing.
Yeah. So before I'd like to elaborate a little bit, and we got a question on the different incentives of the different stakeholders, but just a more general question, and Carl, you touched about it, but maybe you can just elaborate more. You know, what are the reasons for choosing a SPAC versus IPO, and what are the types of likely candidates? Meaning, you know, in the auto tech space, we see lots of companies, capital intense, kind of in nature, sectors, secondary opportunities. How would you define it?
Yeah, I think I would break it down into the more speculative stage world, right? Where you have, the EV, space tech, battery plays, chip plays. And I think for those, it's a couple things. One is the ability to raise a lot of capital, right, at a pretty attractive valuation. And I think for a lot of these companies that are, CapEx intensive, where they've just got very aggressive and pretty long timelines for a build out to get to commercialization. You can go into the private markets and raise that capital over time, right? And take the risk that the markets remain open, because I don't think it's pretty hard to go out and raise $500, $600, $700 million all at once, right? Without a product. And so the ability to go out and raise that amount of money at anywhere from like a $2 billion to $5 billion valuation, it's probably the safest way to raise capital, right? Because it takes care of all your funding up front. It's probably the cheapest way because you're getting a pretty good valuation. And it just allows, theoretically, what it does is it allows the company to just focus on building a product and getting commercial, right? And not having to worry about financing. That to me is the biggest reason to do it versus like an IPO where, I think the reason why you can't go public is via an IPO is it's a condensed roadshow, right? It's a 5-day process. You have to talk to 50, 100, 200 investors. It doesn't allow investors to get deep enough in the company to really understand why they should have that conviction to put that amount of money to work into a pretty early stage opportunity versus, the SPAC process, you have to negotiate with one sponsor. They're going to account for, $200, $300, $500 million of that upfront capital. And then also you're going to have the ability to talk to, a select group of funds to fill in the pipe, right? And that process takes as long as you need, and it's done in the privately, so no one actually knows that you're doing it, right? And so you don't have the time constraint of a traditional IPO roadshow where you have 5 days or 7 days to go out and sell your story, right? So what it is, I think it's more capital at a better price and the ability to go out and have much more detailed conversations with people, right? And then the last piece is just your ability to use forward-looking statements. Obviously, if you don't have a product yet or if you don't have revenue yet, it's a lot easier to sell a story if you can talk about 2023 to 2025 versus, on an IPO roadshow, you're not talking about any of that, right? You're talking about the current year, and that becomes a lot more challenging, right? Like there's just parts of the story that you're not going to be able to tell. So I think that's why you do it. I think the other side though, is you look at an Iron Source and you're like, well, why would they go public via SPAC? It's not necessarily cheaper. It wasn't, it might've been a little bit faster, but they were actually already well on the IPO path. And so from that standpoint, it didn't really save them any time. I think it's it's really about partnering with a best-in-class investor, right? I mean, Thoma Bravo, who was, the SPAC sponsor there, obviously one of the most successful software private equity firms in the world, right? And just, they've just, anything they've touched has done extraordinarily well. And I think the opportunity to partner with a firm like that as a public company, must have been pretty attractive for them to do. So I think it really does depend on the type of the company, but there are good reasons to do it beyond faster and cheaper. It's not the only reason to do it.
Got it. Thanks. And so maybe a question for both of you. With valuation, and then this is a question that I'm being asked a lot by entrepreneur founders of companies. With valuation being equal, how would one go about when choosing which SPAC to merge with? Yeah.
I mean, maybe I'll take a first crack at it. I think what I would say is valuation is definitely, and I think people realize this, is valuation is not the reason to choose a SPAC, right? Because as we said, that the market ultimately speaks on valuation, and when you go out and talk about the pipe, and how the stock trades after you announce a deal, like that's the dictator that dictates, the valuation ultimately. What I would say is what we're seeing is it really is about the fit. It is because, at the end of the day, you're going to have a team that becomes a pretty significant shareholder that will sometimes take a board seat, that hopefully brings, there are different types of SPACs, but a lot of these SPACs are, from people who are, investors, just high quality investors, operational / founders. And so, I think a lot of times people look at that and they say, you know what, like I want to bring a team on board that has a certain skill set that I'm looking for, right? I think, we've had conversations with companies and, ultimately we get chosen because they just like the SPAC sponsor team and because they feel like they've done a great, in one case, it was a VC fund that had basically had a lot of successful exits in the life sciences area, right? And so that was a big reason for why the company that we, we're working with ultimately chose that SPAC, right? And so I think there are definitely qualitative reasons beyond just price as to why you do it. And it really is about that team and not necessarily just about the economics.
Yeah, I would echo that. There are certainly transactions where the relationship between the SPAC sponsor, its investing history, the opportunity set that it said at the time of its IPO that it would be seeking, is a good fit for the target company. So Thoma Bravo Iron Source is a good example. We're doing another SPAC transaction for a property tech company called Latch, which is merging with the Tishman Speyer SPAC. So a real estate investing firm doing a prop tech SPAC. So there are sometimes synergies. First of all, just the sort of seal of approval, the reputational association with a sponsor who works in this space, who knows the space well, saying this is the company that we're choosing to take public through our SPAC, that can potentially create an uplift. And then to the extent the SPAC is bringing directors onto the ongoing public company board, of course, if the SPAC is a good fit for the company from a sector perspective, they may be bringing industry experts onto the public company board that are additive going forward as a public company. So, I think there's a general sense that there are 435 SPACs and each of them basically represents a pile of cash sitting in a trust account. But I think the result of that is that the SPACs are working harder to distinguish themselves from each other. And they're doing that by, number one, trying to align their expertise and their fit with what the company does. And number two, trying to stress their relationships with the PIPE investors that can help facilitate the raising of the PIPE. Those are the two areas where I see SPAC sponsors trying to differentiate themselves in this crowded market.
Okay, thanks. And maybe a question to both of you. So first, Ryan, we touched on this, so maybe just briefly, again, what are the benefits and economics and therefore the incentives? Because we touched on it, but not many people really understand it. For the SPAC sponsors, for forming SPACs, and then maybe to add to this, maybe Carl, the questions that I was asked and actually we have it in the chat from Shmulik Barashin, and what are the real incentives or interests for the PIPE and SPAC investors in this kind of mechanism? It's like it's more clear what was the sponsor's interest, but less the PIPE guys, and the SPAC investors are somewhere in the middle.
Yeah, I think so. For the SPAC investors, it's very much, I term it an arbitrage play, right? Like a lot of these investors actually come from the convertible world. And if you think about it, it actually is very similar to convert in the sense that you have equity upside participation, right? You almost have a call option, right? If the company, if the SPAC finds a good company to invest in. But then to the downside, you have the ability to redeem for the cash and trust, right? So you're protected to the downside by what is basically risk-free capital, right? So I think from that standpoint, as a SPAC investor, as SPAC IPO buyer, the reason you buy that security is you pay $10 per unit, and each unit is comprised of one SPAC share plus anywhere from 1/5 to 1/2 or to a full warrant, right? And so if you think about what ends up happening is you basically get those warrants for free, right? Because at some point you can separate the units into the share and the warrants. That share is going to be redeemable for $10, right? Either A, at the end of 2 years if they don't find an acquisition, or B, if they announce an acquisition that you don't like, you can always go in and say prior to closing, I want my cash, right? I don't want to go through with this trend. I don't want to be a holder in this new company. And so from that standpoint, it's, in a world where, interest rates are close to zero, right? Like if you have excess cash, you could just park your cash basically in a SPAC, right? And basically have no risk to the downside. You're not missing out on any sort of, treasury return or cash return. And you also get this free upside option, right? Where if the deal is well received, then you make money both on the warrants and the equity, right? And so I think that's why, just as you've seen some of these deals struggle, that gets to why you've seen that SPAC IPO volume also slow down a little bit, right? It's not just the glut of supply, it's also the game's not as easy anymore, right? Because rates have gone up, so there's an opportunity cost to that cash. And if the deals aren't trading well, then all of a sudden that upside option isn't worth as much as it used to be, right? So that I think is the biggest reason, why you as an investor would buy a SPAC IPO. On the PIPE side, again, it comes down to just this ability, that your opportunity to come in and buy the PIPE at $10 a share when a lot of these deals traded up right out of the gates, 30, 40, 50%, right? So it's almost like free money, and your lockup restrictions tend to be a lot less onerous than for the SPAC sponsors, right? And so from that standpoint, it was just an easy way to make money where you could see the acquisition that was announced, you could dig in, you could understand the company, and then basically come in, be a buyer at $10 a share, and then when they announce the deal, the stock trades up, right out of the gates, and you're in the money. And so I think that, again, and that's why we're seeing such pressure on the PIPE valuations that are being negotiated. I would say the top was probably, when Lucid was merging with CCIV, news of that deal sort of leaked before it was announced, and the stock traded as high as like 50, $60 a share, right? So basically investors and buyers of SPACs are basically trading the SPAC at 5x the implied valuation for that company. And so they actually got PIPE investors to buy at $15 a share, right? Which doesn't happen very frequently. Since then, the stock has continued to trade above that price, but has come back a lot. And so I think that's where you're starting to see a little bit of pressure, though, is, hey, if the deals aren't trading as well out of the gates, then all of a sudden my desire to pay $10 a share is a lot less interesting, right? Because I might as well just wait to buy it in the open market if I need to. So I think those are the two reasons, though, why we've historically seen such interest in both pieces of the transaction.
Yeah. And, we talked about valuations, and one of the things we're seeing, that are obviously pre-revenues companies reach these dream valuations, and can these valuations negatively impact the company later on, I don't know, on follow-on offerings? Is this something that should be considered? I don't know if you can control pricing, should you? Yeah.
It's funny. So we get asked this question all the time. And Ryan, I know I'm speaking a lot. I can't tell if Ryan's frozen. He may be frozen, but
Can you
chime
hear me?
in. Oh, we can hear you. Your image is frozen though.
Oh, really?
Okay.
Okay.
Yeah. Okay. So maybe I'll start this one really quickly. Just around valuations, we get asked this question all the time. And my view is the market, as a company, as a management team, the market prices you where it prices you, right? Like valuation is something you can't control to the upside or the downside. The only things you can really try to control are basically delivering on sort of the product and financial forecast that you put out there. And so my advice to companies is, just like we tell you to be thoughtful around, don't take, it's not always about the highest valuation. By the same token, it doesn't really help you to take money off the table, right? By shooting for a lower valuation, right? Or maybe making it a little bit easier to beat your targets. Because at the end of the day, the markets are going to trade you where they trade. And it's funny, like when things are good, right? I think the question we always get from companies is, oh, should we take a little bit off the valuation just in case things get worse and valuations compress and it's really hard for us to compare? But no investor in a bad market ever says, hey, you know what? Like valuations are really tight right now. Why don't we pay a little bit more today because we know valuations will be better in the future, right? So I think it's interesting. It's this one-sided dilemma, I think, that companies have, and we don't think it's necessary. Just focus on the business, deliver on what you say you will, and everything else sort of takes care of itself.
Right. Interesting. So, and maybe to Ryan, because we kind of, see in the newspaper, like regulators are starting to talk about those kind of valuations and etc. From your perspective, do you think the regulators will get involved here with regards to pricing? I don't know if they even can, but will there be some kind of an involvement?
Yeah, from a U.S. perspective, there's really not a role for the government to be involved in setting the price or setting the value of the private company. The Securities and Exchange Commission, which is the primary regulator, it's really it's a disclosure focused organization. And so what we're already seeing with the new administration is a number of pronouncements, not actual rules and not actual laws, but pronouncements of the staff's views, and they're really focused on, not surprisingly, disclosure. And so they have been focused recently on disclosures relating to the private company's projections. They've been focused on disclosures relating to the interests of the SPAC sponsor, so ensuring that the average retail investor understands that the SPAC sponsor, who's effectively acting on behalf of the SPAC and negotiating the deal, that it has these Class B shares and it has these warrants that have value only if a business combination gets completed. They're also focused on disclosure around the roles of the investment bankers in providing financial advice or placement agent services on various sides of the transaction. But ultimately, those are all focused on disclosure. And that's really sort of the scope of what the SEC can do. They can't dictate what's the right price. They can't dictate how a company should come to a valuation, what process they should follow. What they really can be focused on, which is I think what they are focused on, is disclosure and ensuring that investors have the best information available when they're making a decision whether to participate in the transaction.
Yeah, and maybe Ryan, maybe you can also touch on what kind of regulation is SPAC subject to, especially in terms of corporate governance or things that you can do in a SPAC process and you are not allowed to do via an IPO. And also maybe if you're seeing any changes to the SPAC deal process from a regulatory standpoint, maybe to be more similar to IPOs in this respect, because kind of start to see those kind of headlines in the articles.
Yeah, so it's a great question. So the SEC is the primary regulatory body, both on the IPO process for the SPAC, but also on the disclosures that are issued after the SPAC merger is signed and announced, and before the SPAC shareholder meeting in the form of the registration statement or proxy statement. And so what you're describing, Taylor, is very much what we're hearing from the SEC, which is they are looking at, and I think many companies think about, going public through a SPAC as an alternative to a regular way IPO. And they are thinking about, from a regulatory perspective, is it true, as is often said to be the case, that it's easier to go public through a SPAC merger? And if the answer to that is yes, there are two ways to level the playing field, right? One is to make IPOs, regular IPOs, easier, to take the best of what's in the SPAC merger and apply it to regular IPOs. That may be easing the regulations around showing projections. That may be allowing for greater input from PIPE investors. So you sort of, you do your price discovery privately as opposed to doing it publicly on an IPO roadshow. The other way to level the playing field is to make it harder to do a de-SPAC merger, right? So then it's just as hard as an IPO. And the SEC's recent pronouncements make it a little bit unclear, to me at least, which way they think this should work. So I think there are some things about the traditional SPAC merger that they're testing. For example, the way projections are used and the way that companies think about that they have a safe harbor from liability for those projections. But I also think they're, on the other hand, looking at, well, what works well in a SPAC merger? Why has the market gravitated to SPAC mergers? And is it possible that we can incorporate some of those features into the regular way IPO to make the regular IPO more attractive again?
Excellent, thank you. I'm cautious of the time. Maybe another question, and then I want to allow some time to Q&A. Maybe this one for Carl. You know, in an IPO, after the first year, the market has expectation for the company to grow. We mentioned that in SPACs, you can provide long-term projections. To what extent do you expect the market to have patience to see those early pre-revenue companies growing to their long-term projections?
I mean, look, the equity markets aren't very patient, right? I think that's the reality. I think a lot of, it's interesting, right? Now we're starting to see sort of this shakeout occur now in some of these earlier stage companies. You've seen, you know, companies like Momentus have delays in their first planned launches. You've had companies like Lordstown basically come out and say, you know, what we call contracts or orders weren't really formal contracts or orders. You know, you've had business, you know, Chiou, for example, has announced sort of a business model shift or transit pivot, whatever you want to call it. And the stocks are getting hit, right? And I think the reality is, you know, investors aren't used to investing in these types of companies, right? These are basically early stage venture style investments at pretty big scale. And I think the market is still adjusting to how these are appropriately valued and how these stocks are traded. And so I think from that standpoint, if you're an early stage, you know, sort of like early stage, sort of more industrial tech or deep tech type company, you just have to know, right? And this is what we talk about. It's like 6 months after you go public, no one cares how you got public, right? All they know is you laid out a certain path and you better hit those targets. Otherwise the stock gets punished, right? And so, you know, and that's why I think, you know, to the question earlier about valuation and do you try to solve for like a lower valuation? Like you can't, right? Because the reality is if you execute, then people are going to be happy. If you don't execute, people aren't going to be happy. And the fact that you like took a lower valuation up front isn't going to change that, right? And so I would just say, yeah, it's just people are learning along the way. And I think we all are, just in terms of, you know, I think we all suspected that the hit rate wasn't going to be 100%, but now we're seeing it play out where the hit rate's not 100%, right, in terms of success. And so it'll be interesting to see how that all plays out. The other thing I was going to do is, I know Shmulik, you had a question just around, you know, a path for traditional company, you know, not a dream slash, I'm just reading the question, not a dream slash startup type, but one which has a roll-up thesis and appreciation with 10x transaction value. I think that's actually something that we've been doing a lot of work on. You know, just William Blair as a firm, we do a lot of just M&A out of the PE channel. And there, as you can imagine, there's a lot of companies that, you know, are doing maybe, you know, whether it's 20, 25% or 15% organic growth, but then looking to do a roll-up type strategy that gets them to say 20 to 30% sort of combined organic and inorganic growth. That is a story that we think resonates extraordinarily well with the SPAC universe. And again, it comes down to this ability to raise, you know, for the PE guys, it's a couple of things. One is, you know, because of the quantum of cash that you're able to raise, because you can go out and raise 500, 700, $1 billion, what it means is, as a sponsor, as a PE sponsor, I can take some money off the table and still give the company a lot of cash to go out and execute on that M&A strategy, right? And so what I would tell you there for just general sort of guidelines is, when we've spoken to SPACs about these types of ideas, you sort of want to see no less than, call it 10% to 15% organic growth, and then an expectation that you can, double that growth, get into the 20 to 30% area in terms of combined through organic and M&A. And then the other piece that I would lay out is, it also helps, not surprisingly, that if you have sort of a track record, right, of successful M&A, both in terms of identification and then also integration, right? Like if you have that track record where you can say, we've over the years layered on like this transaction, this transaction, this transaction, and this is what it's driven, I think that story of future sort of M&A becomes a lot more credible. So it's definitely possible, and I expect to see a number of these transactions get done in the coming months.
Excellent. That's helpful. So, looking at the time, Carl, Ryan, any other remarks with regards to this topic that you want to convey? And any other questions maybe from the audience? And so maybe last question both to Carl and Ryan, and we started with this, and this is kind of looking forward, and it's the question, the usual questions: are SPACs here to stay, right? And I would say, what are your 2021 or even 2022 projections for this new phenomena, or not so new, like year and a half trend?
I think they're here to stay. Look, even despite all the hiccups, we continue to see a tremendous amount of activity. We're working on a number of transactions on the sell side where, the private equity or VCs, backers want to target SPACs because of all the reasons we've talked about, right? The ability to raise a lot of capital for companies, the ability to go out and tell a more detailed story that's, maybe forward-looking, or maybe just gives you more time with a smaller group of investors to go out and sell that story. There are very real reasons beyond just SPACs are the hot thing to do, I think, that are going to make this a real asset class for a long time. And I think, look, the ironSource transaction to me is transformative. I think it's just an entirely different class of company. And so, I think you can no longer just sort of say, oh, these are just low quality. No, these are companies that couldn't get public because they're too early stage, or, maybe they're not growing fast enough, or they just don't have enough scale. ironSource would have been a best in class IPO, right? That would have been $1 billion plus IPO, and they went down the SPAC path. And so it has to raise the question of, why is that? And when you sort of peel back the onion, there's definite reasons for why they did it.
Excellent. Okay, we have another question. What is the minimum valuation to merge with SPAC?
Well, maybe I'll give the legal answer, and Carl, you can give the
Yeah.
The legal answer is that the SPAC, in its business combination, the business or set of businesses that it acquires or merges with in the initial business combination has to have a fair market value as determined by the SPAC's board of directors, at least equal to 80% of the value of the trust account. So if the SPAC did a $300 million IPO, they have $3 million in the trust account. They need to determine that the value of the business they're acquiring is at least $240 million. So that is the technical legal minimum. As a practical matter, as I mentioned, the average SPAC merger in the last 15 months or so, the value of the equity of the private company has been about 5 times the size of the SPAC trust account. But if the question is minimum, then from a legal perspective, the minimum is 80% of the size of the SPAC IPO. And Carl, you can maybe give your market.
Yeah, I think just from a market standpoint, I don't think, for most companies, certainly you can get public for lower, but I would say the minimum valuation, you think about it again in the context of being a public company. And I think being less than, say, $700, $800 million of EV is a really tough place to be, because it's just the liquidity is not there. A lot of investors won't buy because they just don't believe that there's enough liquidity once you drop much below that, right? And so I think from that standpoint, you should be solving for a minimum price of 700-800 million, you know, but I would even say like billion is really, $1 billion is where you want to be, right? Because again, it just gives investors the ability to buy in size that matters to them, and that's what gets the most interest.
Great. Excellent, guys. This is super helpful and very interesting. So if there are no other questions, so let me thank Carl and Ryan.
Actually, the one thing I was going to add is, you know, the one final point I was going to add, because it's something that we observe a lot in the market these days, is, you know, obviously there's just a ton of money, right, in fees in play, right, in the SPAC world, across the IPO, the merger, the M&A, the sell side, the buy side, the de-SPAC, et cetera. You know, I think one of the things is, you know, as you know, for everyone on this call, as you think about your portfolio companies and just sort of how you work with banks, the one thing I would say is, you know, where banks have not done a great job is just around the education process, and in terms of sort of truly sort of explaining the nuances of what the SPAC process means, right? And what, you know, like what it means to be a public company, right? Like we've had companies tell us after they've merged, basically say, oh, I didn't even realize I had to go and do investor marketing, right? Because the bankers never told them they had to go do investor marketing after they de-SPAC. Like, you should probably know that, right, as a CFO or CEO, but it's also incumbent on the bankers to tell you that, right? I think also even just, you know, one of the things that we're seeing is, you know, on the SPAC IPO side, right, where, you know, bankers were saying, oh, you want to do it with one counterparty, you should have like a sole book runner, do it. And what companies are realizing now is it actually creates a lot of issues, because now all of a sudden, if your sole book runner on your SPAC IPO is conflicted, you don't have an advisor, right, as you go down this buy side process, right? And so what you're seeing now is, you know, SPAC sponsors say, hey, we want to actually bring in a few more underwriters rather than just go with one. And so I think one of the keys here just to having a successful transaction, as you think about, you know, portfolio companies, is just making sure you have someone that you trust educating you on all the nuances of this, because it's a complicated product and it's really easy to get fooled into thinking it's like this easy, fast way to go public. It can be, but there's a lot of complexity behind it, and just making sure that you have someone on your side that you can sort of help educate, you know, make sure that you're fully educated.
Yeah, absolutely. All right. So again, let me thank Carl and Ryan for joining us today, and thank you so much for the time and for the information that we've got. And thank you all for joining us. So that's it for tonight, and thank you, everybody. Bye-bye.
Thank you, everyone.
Thank you.
All right, have a good night.